Millions of Canadians every single day pick the wrong mortgage product, and it costs them literally thousands of dollars. In fact, sometimes tens of thousands of dollars, simply because they didn't know the right way to pick a mortgage. So today, I'm going to give you the 3 top considerations that you need to be thinking about if you're thinking about picking a mortgage product, and a scale to help you make the right decision. Now, before we get into it, my name is Alex McFadden, and I'm a mortgage broker and focus on educating people around the different ways and strategies to help to create wealth in real estate. And one of those ways is educating people about specifically mortgage products. So my only ask from you today is, if you're getting some joy out of this channel or some value, make sure to hit that subscribe button, that like button, so we can make sure to continue to bring more value to you in the future. Now, let's get into it, shall we? So you're thinking about getting a mortgage. Now, it could be your first, second, or third mortgage, and you're trying to figure out, how do I pick a product, fixed or variable, and how do I pick a term length? Like, what does that even look like to me? So today we're going to talk about a few key considerations that you can use to help you determine specifically the right types of products for your needs. Now, before I get into this, there's no way that I can cover in one video every single different type of lending product or institution. So I'm going to talk in general terms, but it will help you to guide on the type of situation that you have available. The other consideration is, I'm assuming in this conversation and this video that you qualify for a broad array of different types of products and solutions. Every person's situation is different, and so you may not qualify for all these different terms. That being said, let's get into it. So before we get started, it's important to know that mortgages come in a variety of different flavors: open and closed, term, no term, home equity line of credit, mortgage. Today we're talking about specifically mortgages and not home equity lines of credit. So the first thing to note is that an open term mortgage is simply just that. It's a mortgage that is open, meaning that you can take it on, borrow the money, and you can pay it off at any time and exit the mortgage lender with no additional prepayment penalties. You're not locking into a particular term. A closed mortgage product is one that has a term. Now, in Canada, the mortgage terms range from 1 to 5 years, 6, 7, and 10 years traditionally. Those are the lengths that you're actually locking in to a particular type of mortgage rate or discount, and of course that you're staying with that particular lender. If you leave the lender before the end of the term, you typically pay a prepayment penalty, which leads us to our first step of how you pick a different type of lender. The first things to consider are flexibility and risk. So let's talk a little bit about flexibility. If we're thinking about flexibility when it comes to a mortgage, most people are like, what are you talking about? Why does flexibility even matter? Well, the reality is, 1 year is a long time, let alone 3, 5, 7, or 10 years. And for most people, when it comes to a home, a lot of things can change, whether it's jobs, having babies, getting divorced, deaths, etc. And they don't happen in most circumstances at times that you expect. So flexibility can be key for a lot of different reasons. You need to access the money. You need to sell your house. You need the opportunity to be able to restructure your loan or restructure your debts. You want to move. There's so many different reasons. So when you're considering the different type of mortgage product that you're looking at, we'll think about it like on a scale of 1 to 10. Now, on one end of the scale, for the least amount of flexibility would be like a 10-year fixed mortgage. So that's a 1 on the scale. That's 0 flexibility. You're locked in. You're stuck for 10 years. Now, on one hand, you get a great amount of certainty. You know for a fact that for 10 years, you're locked in that mortgage rate, nothing's happening, and of course, you know exactly what you're paying. But on the other hand, if you were to exit that lender before the end of the term, not only will you pay an interest rate differential penalty, you'll pay a dramatic amount more than almost any other term. And now, traditionally speaking, on a 10-year mortgage term, you're also paying a premium on your interest rate. So you're gonna pay a higher interest rate to lock in for that period of time. Your assumption is obviously that your life is changing and that you don't have access to the ability to renew, or you're just concerned that interest rates are gonna go up dramatically. So that's on the one end of this spectrum. For the other end of the spectrum, think of it as a scale of 10, 10 being the highest amount of flexibility, is that open term mortgage, meaning that you can come in and come out at any time. So you're gonna pay the highest interest rate associated with term to have no certainty, because the bank isn't able to keep your money and know how long that you're actually going to be paying interest. But of course, you have the ability to get in and pay out. What I would consider to be really kind of closer to that 10, if you were to actually look at a mortgage term, would probably be something more along the lines of a variable rate mortgage. And the reason for the variable rate mortgage is because although there's some fluctuations and different times can mean higher or lower interest rates, when it comes to flexibility, you're locked in at a certain discount, but you can exit the term anytime by just paying out 3 months worth of interest. And that's it. 3 months. You can calculate that based on your current interest rate at the time you discharge the loan, along with the amount of interest you're paying on a monthly basis. Now, an easy general calculation, please don't take this as the gospel, but if you're just trying to get a rough idea, is to about 0.5% of your loan amount at any given time. Obviously, this is subject to where rates are at the marketplace. Now, if you're trying to get a quick quote, make sure to reach out to your lender directly to get any of this prepayment penalty calculations. So obviously, we've went on the scale from the 1 to a 10. Somewhere in the middle of that scale is going to be a middle of the term, something along the lines of a 3-year fixed mortgage rate, which is probably smack dab in the middle. It's about as vanilla as you can get. Generally speaking, it's relatively safe because 3 years, the average Canadian breaks their mortgage at just over 3 years. And so it would make sense that that would be probably right in the middle in terms of high or low risk and flexibility, which leads us to our next step of the process. So now that you have the flexibility scale, it's the same concept, but the concept of risk. So in a higher rate environment, or when rates are going up or going down, generally speaking, a higher quote unquote risk would be something along the lines of a variable rate or a 1-year term. The lowest risk, as far as just generally speaking, rates changing or fluctuating, would be back to about a 10 on the dial. Again, we don't typically suggest the 10-year term. And if we were looking at a short term like 1 year, we would always want to make sure our borrowers are well capitalized, meaning you have lots of backup money in case rates were to go up or they weren't to come back down. That is the second consideration when thinking about how to pick a mortgage product. Other considerations that you really want to be thinking about is, what type of lender am I working at? Now, this is really important. There's a few key reasons. One, are you with a traditional bank that's national across the country, or are you with a local credit union? Now, the lender type can be pretty important because, again, let's assume that you're someone who moves. Maybe you work for a company that is across the country and you move from BC to Ontario. And if you're with a credit unions are typically not national, they're usually localized. They would normally not be able to port your mortgage or transfer your mortgage over to another province. And in an increasing rate environment, that can be a big deal. And if you also don't want to pay prepayment penalties, another big deal. Now, with the large banks that you're looking at, you typically have a wider variety of products available to them with more strict underwriting guidelines in some situations. But the challenges with the large banks is that they can be relatively strict. They don't have good quality of service. And in addition to that, you'll find that with larger banks, you'll also pay the highest prepayment penalties if you have to exit the loan early. Now, when you're thinking about the different types of products that you're looking at, one of the other considerations that you'll be thinking about is quite simply a fixed rate or a variable interest rate. We touched on it in the beginning of the video. A fixed rate remains the same 1 through 5, 6, 7, and 10 years. The reality is, if you take a fixed interest rate, you know exactly what you get, you know exactly what you're going to pay, and you know where it's going to be for a period of time. Typically, there's a premium associated with that, meaning you're going to pay a certain increase in interest rate depending on where the rate environment is for a shorter or a longer term. So you have to keep that in mind when you're judging your options. Whereas a variable rate mortgage, you typically have a discount. So if prime is at 5%, you would get a discount of 1%, which would mean your actual interest rate is 4% today. The pros associated with that, again, is the ability to exit the term early at 3 months of interest, and the fact that if rates were to float down, you can benefit because of rates going down. The cons being, if interest rates were to go up, you would see your actual interest rate increase and prepayment penalties go up because you're paying more interest associated with that. So some considerations when you're thinking about those mortgage products outside of those considerations, the last ones would be, do you need access to a home equity line of credit in the future? As we suggested, what's more important to you when it comes to location or product type and the customer service or experience? There are lenders out there called monoline lenders, and those monoline lenders, generally speaking, offer way better customer service. Interest rates are generally speaking comparable to the banks, but they have flexibility that allows you to transfer to different institutions at the end of the term for a lower cost. So the other things to be considering if you're looking at, or a general list of different things to be looking for when you're picking a mortgage product, are what's the likelihood that you would move or potentially have a change in the middle of the term? If interest rates are going up or down, how is that impacting your decision? Looking at the rate environment is really key. We talked about prepayment penalties. So are you okay and are you comfortable paying a large prepayment penalty if you had a life event or if rates were to go down and you wanted to access that? What is the total amount of interest that you're likely to pay over this term? Again, you may not want to look at it over 25 years, but over 3 years or 5 years, what is your total interest that you're paying? And last but not least, what is your level of risk? Because that will help you to understand specifically which of those options that are important to you. Now, of course, that's not an exhaustive list. We can go on forever when it comes to mortgage products, but I hope that provides you with a clear direction of different types of options that might be available to you and define specifically how to pick a mortgage product. As always, if you're liking the videos, make sure to hit that like button, that subscribe button. We'll see you at the next one.